Oracle stock has fallen from a 52-week high of $345.72 to about $121. That is a drop of roughly 65%, even though the company just reported some of the strongest growth in its history. So is Oracle broken, or is the market pricing in too much fear? Oracle is no longer just an old database company. It still owns one of the most important enterprise database franchises in the world. But it also sells cloud infrastructure, business applications through Fusion and NetSuite, and healthcare software through Oracle Health. The main growth engine is Oracle Cloud Infrastructure, or OCI. In fiscal Q4 2026, Oracle's total revenue reached $19.2 billion, up 21% year over year. Cloud revenue climbed 47% to $9.9 billion. OCI infrastructure revenue exploded 93% to $5.8 billion, while cloud applications revenue grew 10% to $4.1 billion. GAAP operating income reached $6.1 billion, up 20%, and GAAP earnings per share rose 21% to $1.45. For the full fiscal year, revenue reached $67.4 billion, up 17%. Total cloud revenue hit $34 billion, while OCI revenue increased 77% to $18.1 billion. The biggest number, however, is Oracle's remaining performance obligations, or contracted revenue backlog. RPO ended the quarter at $638 billion, up 363% from the previous year and up another $85 billion from the prior quarter. That backlog is not immediate revenue, and it will be recognized over multiple years, but it shows that demand for Oracle's AI cloud capacity is far larger than what current revenue reflects. Oracle also said $75 billion of its large AI contracts includes GPUs that were prepaid by customers or supplied directly by them. That matters because it reduces part of the capital Oracle must provide itself. Management expects the acceleration to continue. For fiscal Q1 2027, Oracle guided for total revenue growth of 27% to 29% and cloud revenue growth of 58% to 64% in US dollars. For the full year, Oracle maintained its $90 billion revenue forecast. Reaching that target would mean adding more than $22 billion of revenue in 1 year. Oracle's multi-cloud AI database business also grew 404% in Q4. That strengthens the bull case because Oracle is not relying only on renting GPUs. It can use its database, applications, and cloud infrastructure together to capture AI spending across the enterprise. This is why the business looks stronger than the stock chart. But Oracle's stock did not collapse because growth disappeared. It collapsed because the cost of delivering that growth has become enormous. Oracle generated a record $32 billion of operating cash flow in fiscal 2026, up 54%. But capital expenditures surged to $55.7 billion from $21.2 billion the year before. That pushed free cash flow to negative $23.7 billion. Oracle ended May with $31.3 billion in cash, but it also carried about $129.5 billion of current and long-term borrowings. In Q4 alone, interest expense rose 47% to roughly $1.4 billion. The company raised $43 billion through debt and $5 billion through equity during fiscal 2026. For fiscal 2027, it expects to raise approximately another $40 billion, including a $20 billion at-the-market stock offering. That creates two risks: dilution from new equity and higher interest expense from additional borrowing. S&P Global recently downgraded Oracle's credit rating from BBB to BBB-, only one level above speculative grade, citing rising business risk and weaker cash flow during the AI expansion. There is also concentration risk. A $638 billion backlog is powerful, but if a few AI customers represent a major portion of those commitments, Oracle becomes dependent on their ability to fund long-term contracts. The market is no longer treating Oracle like a safe, mature software company. It is pricing Oracle like a leveraged AI infrastructure build-out that still must prove its economics. At roughly $121, Oracle trades near 22 times trailing earnings. That is not extreme for a company targeting about 34% revenue growth in fiscal 2027, but the PE ratio does not fully capture negative free cash flow debt, and possible dilution. My view is that Oracle has become a high upside, high execution risk AI stock. The bullish scenario is simple. OCI keeps growing, the backlog converts into revenue, cash flow catches up with capital spending, and Oracle proves its AI data centers can generate attractive returns. If that happens, today's stock price could look deeply undervalued. The bearish scenario is that construction costs stay high, customers delay capacity, financing gets more expensive, or dilution grows faster than earnings. Then the stock could remain under pressure even while revenue rises. Oracle is not a blind buy just because it fell 65%, but for investors who believe Oracle can execute on its backlog and restore positive free cash flow, this may be one of the strongest AI turnaround setups in the market. I would treat it as a long-term position and enter gradually instead of buying all at once. Not financial advice, do your own research.